Last year, the Chinese authorities went after some of its own big tech companies who had become too big to control. Jack Ma, the founder of giant Alibaba, had become emboldened to the point that he publicly criticized members of the Communist Party. For Beijing, the economic powerhouses that are helping China become dominant are also a threat. With new rules and restrictions now reigning in big tech, Beijing is training its sights on the oil industry, with teapot refineries its main target. This week, Beijing announced huge cutbacks in import quotas for private oil refiners. Crude oil import quotas are now 35% lower than at the same time last year. The problem with these independent refiners, also known as teapots, is that they have become increasingly dominant over the past 5 years. Ever since Beijing partially liberalized its oil industry in 2015, China's teapots have been steadily grabbing market share from entrenched state players such as Sinopec and PetroChina. Teapots currently control nearly 30% of China's crude refining volumes, up from about 10% in 2013. Beijing is trying to accomplish 3 things in this latest crackdown. First, it's trying to regulate the flow of foreign oil. Second, it's trying to double down on tax evasion, fuel smuggling, and environmental violations perpetrated by these refiners. And third, it's trying to wrestle back control of crude refining from private entities to state-run refineries. China's national oil companies will emerge as the winners here, not just because of the slashing of crude import quotas for teapots, but because of stricter emissions targets that the NOCs can more easily comply with.